Welcome all. Reserving. This is very, very important in life insurance policies, particularly in part 2 of CM1, because without reserving, will not be able to run the company. Suppose we have a policy and this is for 20 years. And many policyholders, they have taken the policy, term assurance policy, even life insurance policy, it doesn't matter. What will happen is they will pay premium one time or monthly, yearly, whatever way, it doesn't matter. They will continue to pay the premiums. And you know how to calculate premiums? And once they will die, someone will die here, someone will die here during 20 years. Many will not die also. That's fine. But those who will die, company has to pay some amount immediately or at the end of year of death. Benefit. Now, to pay the benefit, insurance company, life insurance company needs to have sufficient fund to pay. If there is no reserve, I'm not talking about reserve of the company. I'm not talking about reserve of the whole company. Whole company is there. They will have reserve. I'm not talking about that reserve. Reserve is specific to our life insurance policy. Okay. So we are talking about a particular policy. Suppose you can name any policy. Jivan Tarang. Suppose this is a policy, LIC policy. So we are talking about this policy, this portfolio policies. So here the policies. See, company has reserve. I'm not talking about that. I'm not talking about company reserve. I'm talking about policy reserve. Here, for these kind of policies, we should have reserve here. Otherwise, there is problem. There will be problem in future. Suppose we'll collect money from each one. They will pay, and insurance company spends all the amounts. Then what will happen? Where the money will come? Suppose someone claims, and insurance company will not be able to give money here. Then next time, people will not take the policy. Once people will not take the policy, they have to shut down their business. That's the problem. So how can you avoid the problem? So it's better to keep reserve. There are two types of reserves. One is prospective reserve and the other one is retrospective reserve. We'll not talk about retrospective reserve here because in the new syllabus that is there towards the end and not given that importance. Reserve is prospective reserve. What is prospective reserve? It's like this. Suppose these are the points and this is a whole life policy. Then what will happen? Year to year, company has to keep reserve. So here there is no reserve now. Here there is no reserve, zero reserve. Okay, there is no reserve. Why there is no reserve now? Suppose someone is 30 years, there is no reserve now. Then what will happen? This is 1. Will continue. This is 0. This is 1. This is 2. This is 3. This is 4, 5, 6, 7, 8, 9, 10. So here suppose age is 30 and then 31, 32, 33, 34, 35. Continue writing. Here there is no reserve anyway. No reserve. Why there is no reserve? You need to think that. Now come to this place. Here there will be reserve. Then here there will be reserve. then here there will be reserve, then here there will be reserve. The name is V1, reserve at time 1. We write this way. We don't write age here. If you want, you can write age here also, 31. But yeah, let's not make things complicated. This is V1, and then the reserve at this time is V2, reserve is V3, here reserve V4, then here reserve V5, then here reserve V6, here V7, here V8, here V9, here V10. These are the reserve. If you ask me whether the reserve will increase or decrease, I can say now. Even nobody can say. It depends. And from year to year, company has to change the reserve according to the requirement. So how much reserve you need here at this point, time 1, that must be exactly equal to the requirement. That means saying prospectively how much reserve you need here. Here it's 0. Then from 0, we'll try to make it a positive one. How that's possible, we'll discuss. Here there is no reserve, but people are here. They will take policy. They will in advance, they will pay premium, and that premium will come. Initially, what will happen? There will be some setup cost for the company, and there are some initial cost also. Apart from that, if nobody will die here, then the money will be rolled forward to the next year. If somebody dies here, suppose there are 10,000 people, one or two they die, they will die within 0 to 1, then they have to pay money here at the end of the year. Suppose, because there are so many people, they will give premium, they will pay benefit only to, suppose 5 lakhs benefit, 10 lakhs they will pay, and they paid some amount, okay, and that amount after the initial setup cost and initial expense, that will be invested. And finally, suppose the collection here is 50 lakhs. That 50 lakhs, after some initial expense, setup cost, everything, say the remaining is 48 lakhs, that will be invested for 1 year. Suppose that will grow to 52 lakhs now. And if the benefit is at the end of the year, or maybe here also, they will pay that amount wherever it is. Suppose two people will die, 10 lakhs they will pay. And supposing that 5 lakhs is the sum assured, whatever remains here, okay, that will be what? Suppose they will pay 10 lakhs here, and you have, sorry, here they die, and here you pay at the end of year of death. Then 42 remains. What is that 42 here? A part of 42 they will keep for reserve, not full 42. A part of 42 will be kept here at reserve. Why part of 42? Why not full 42? Who can answer? Why part of 42? Why not full 42? Who can answer? Because ultimately this is a business, and they will take the profit, okay? The policy, the stakeholders of the company, suppose these are the companies, these are the stakeholders of the company, okay? They started this company, and they appointed staff here, including actually all the staff they appointed, okay? So obviously they will take the money from them, okay? That will also be kind of expense. Apart from that, whatever remains here, that part will be shared among themselves. Remains means after keeping the reserve, okay? You keep the reserve. Suppose you have 40, 48 to, it grew to 52, and they paid 10. Now 48 is there. Out of 48, they will keep reserve, okay? Some amount. Then whatever amount remains, that you will be able to know after a month, or maybe 15, 20 days, okay, how much amount to keep here. And the remaining amount they can distribute among themselves in the form of profits. Important thing is to keep reserve here. So what amount you require to keep reserve here. That notation is V1. There is a formula. V1 is the reserve at time 1. V1 is the reserve at time 1. Reserve means what? Suppose you consider one person now, okay? Reserve is this. You consider one person. You write this way. And this person, suppose this is age 30, 40, whatever. Ultimately, this guy will die somewhere, okay? So when the guy will die, then company has to pay money, right? So company has to pay money whenever this guy dies. Suppose he dies here. Before dying, this guy will give premiums, and here this guy will receive the benefit. That is already there, that we know. We'll do something more here. Suppose now 50, because we want to find the reserve at 50. I mean time 10. Reserve at time 10 if you find. Okay, let's not disturb that. That was different. Suppose you want to find the reserve at this point 10. Here you are finding reserve for this guy, and this guy is surviving, right? So this guy is surviving now, and you want to keep reserve for this guy. Okay. Now, so what will be the reserve? That will be outgo minus income, expected present value of outgo. I'm writing here expected present value of outgo minus expected present value of income. Why like this? We'll discuss that. Outgo, what will be outgo here? Outgo is whenever this guy will die, company has to pay sum assured 1 or S, whatever. Suppose sum assured S. What is the expected present value here? Now you see the age. SA50, that is expected present value of outgo minus, considering that the premiums are collected in advance, and that is true, PPP till this person dies. So that will go to the company, and this amount company has to pay. We are not considering this time now. We are finding reserve here. Forget about past. We are finding reserve here. That's why prospectively we have to see. So the present value of this one, expected present value, here this is a annuity, many payments. Here one payment, that is the assurance function, and annuity will be P A due 50 here. That's all. That is the difference. The difference is the reserve. That amount you need to keep. To make the things easier, you remember this formula. Let me introduce this. Suppose you are someone and you need some money in future, okay? And you wanted some money from your friend, and you are now standing here a bit worried, okay? You need money for, why you are worried? Let me change a bit example. Because you have to pay someone, suppose 75,000 in future, and you know that you will get income in the form of your salary, and you can save up to 50,000. Suppose 2,000 you can save. I'm not considering interest rate now. And suppose 10 years, in 10 years time, you will save 10 into 2, 20,000. Okay. You make it 20, 20 into 2, 40,000, or make it 30. Okay. So in 30 years, you'll be able to save 60,000. So you know that this is a long time, 30 year. Okay. You think that these are monthly, 30 month. Okay. So you know that the monthly income, from the monthly income, you can save 2,000, and you will be able to save 60,000. I'm not considering the interest rate here, but you have to pay 75,000 anyway. So now you are planning to get somewhere 15,000. That 15,000 extra, again I'm saying I'm not considering interest rate here. That extra 15,000 you have to arrange now, because you know that from your office salary 2,000 they will cut and they will take the rest amount. You have to arrange from somewhere, and you keep here, so that when the time will come you will be able to pay this money 15,000. This is reserve. You want to keep reserve. If you consider the interest rate, you can calculate. Suppose if you find SN, okay, S30 to S30, suppose this will be 65,000. So 10,000 is the net, the difference between this 10,000 extra you need. And if you find the present value of 10,000, suppose that is 8,000, okay, that way also you can calculate that this amount you need to keep now in the reserve. Reserve is that amount which will be useful for you for the deficit part. It's not that whatever you need that you keep. If you have no income, suppose I have no income, I don't have any monthly income, and I need to pay someone 75,000, okay, then I need to keep 75,000 if there is no interest rate in the market. However, if there is interest rate in the market, you discount it. This is 70,000, you keep 70,000, and it will grow to 75,000 and you give it. That's all. However, if you have income here, you know that you will get some income during that time, whatever 30 months or maybe 40 months, whatever, you will have income. So that income will accumulate to something, suppose 50,000. So you need 25,000. You don't need 75,000. And 25,000 discounted value, if you find, maybe it's 20,000. That is reserve. So reserve is the deficit amount. And here present value. Present value of the deficit amount is the reserve. Now let's go back to that. This one. So here we use expected present value. Expected present value, because there are so many people, they will take the policy, but we'll consider on an average one people and we'll calculate that way. Per person we calculate. Okay. So let me write properly the formula. The formula for reserve is this: VT is equal to, remember, AX plus T minus P A due X plus T. This is the formula for reserve at any time T. Okay. That means here, suppose time is 0. Sorry, here we've taken time 0. And here time is, if you start from 40, this is 50, time 10. If you find reserve at time 10, T is 10 and X is 40 here. So this is 50 anyway. This age we have to take A50. If the sum assured is 1, if the sum assured is S, you can write S as well. Whatever sum assured, that is the expected present value. Already we know. Minus P A due X plus T. X is 40, T is 1050 here. That means at this time, whatever amount you will pay in advance till death, that present value is this one. This amount insurance company will receive in the form of premium, and insurance company has to pay S. The discounted value, present value is, expected present value is SA50. If you are saying where A50 came, you can visit the other chapters, okay, the previous chapters. A50 is the expected present value of benefit. The only difference here is we normally used to find at 40 because policy started here. Now we are finding here. So reserve we can find at any point. Even if you find at 0, what will happen? Suppose you take 0 here, T0, it will be SX. That means you are finding reserve here at time 0 minus P A due X. And by virtue of equation of value, because they're equal, that is 0. They're equal, right? This is equal to this. That is equation of value at time 0. So reserve at 0 is 0. Because reserve means this is money from the policyholders. So because policyholders have not paid anything now, so there is no reserve. Once policyholders will pay in advance here, then that amount, from that amount only we'll keep a part of that here as reserve. So money, before money comes, you have to keep reserve. That means here when I say reserve at time 1 is V1, reserve at time 1 is the time which is just before the premium collection. So let me write here, this is convention, this is very, very important. Here premium will be collected. Here premium will be collected. Here premium will be collected. Premium will be collected after setting the reserve. So now let me write it here. Reserve at 1. I have to see the age, otherwise I will not be able to write. Age is 31. V2, it will continue. Okay, this is reserve formula. That's all. These are the prospective reserves. Okay, different points. Every year you have to find the reserve and you can check. It's like balancing. Okay, suppose I have money or maybe I have water. Every day, suppose I have this much water today, I will consume some water, and then some more water I will get from outside, and this much water I will keep. It will depend on how is the weather. Maybe day after tomorrow I'll keep this much water. I need to manage the reserve, seeing the weather, the future weather. It's rainy weather, or maybe it's very hot and humid outside, hot weather, or it's winter. It will depend. Okay, so that way I will manage. So sometimes I need to throw something, sometimes I need to keep something here. That way you have to manage reserve each year. There is a formula. That formula you need to know. This formula VT. If you want, you can write X also right side. So we'll do some problem. Let's go to the first problem. This is also not required. Yeah, this is the first problem. A 10-year term assurance with a sum assured of 500,000 payable at the end of the year of death is issued to a male life aged 30 for a level annual premium of 330.05. This is given, otherwise you can find it. Not a problem. You can solve the equation value and find the premium. Calculate the prospective and retrospective reserve. As I said, you will not be requiring retrospective reserve here. Calculate the prospective reserve, that is called reserve year, and that's the net premium reserve at the end of 50 year, just before the sixth premium has been paid. Okay, so you need to draw the number line. Again, basis M92 mortality and 4% interest rate. Ignore expenses. For the time being, there is no expense. This will also come very soon. Now, if you see the solution prospective calculation, it's very easy. This is expected present value of future premiums. Okay, this is expected present value of future premium. Okay, let me write this way. If you see the age here, 10 year, right? Okay, 10 year age is 30. Now 30, and it's for 10 year. So it's fixed actually. 10, 40 you can write. So within this time, you can find reserve. Okay, you can find V0, that is 0, V0, V1, V2, V3, V4, V5, V6, V7, V8, V9, V10 you can find. What is V10 here if you find? Who can answer? V0 is 0. Left hand side we are writing here. What is V10? We'll calculate different thing though. We'll calculate here. Reserve at the end of 50 year. End of 50 year means this is end of first year. This is end of second year. This is end of third year. This is end of fourth year. Fourth year means 3, 4. First year means 0, 1. This is end of 50 year. Okay. Just starting the sixth year. That means here they're asking to find V5. So if you write the formula for V5, whatever I said, if you follow that, you have to write this one 3. This is the premium, and this one the sum assured. So SC into the present age is 30. Sorry, present age is 35 minus P A due 35. This is for whole life. The formula I said just before, that is for the whole life, but this is term. And logically, you should know. For everything, you will not remember the formula. Term means you make it a term. This is only available for 10 years. So 35 to 5 year remains now. So from here, instead of infinity, we have only up to 40. So that's why you have to write 5 year. And term means you have to write 1 year. Here also 35, 5 you have to write. There is no term thing here in case of premium. So this will be V5. If I change it to whole life, then things will change. And SP, you know, this is your P, this one is P, and this one is S. If you see the solution, only one part is there. Okay. This is the premium part. Another part you need to calculate. You do that, and then you will get the value. If you see expected present value future benefit, that is A35.5, 1 here, 500,000, and you have to apply the formula, you have to get it 1708.52, and prospective reserve is this minus this. This is the one you have to pay. I mean, present value of what you need to pay in future. This is present value of what you will get in the form of income. I'm talking about the insurance company. And this is the amount 182, that is the balance amount you need to keep now. Everything is present value, expected present value. So this is the expected present value of what company is preparing to pay, and thinking that the present value of the income they will get from the policyholder, from that single policyholder I'm saying is this. Then the difference is per policyholder, they have to keep 182 now in the reserve. If there are 10,000, 10,000 into 182 in the reserve, they have to keep. This is reserve per person, remember. Otherwise, there will be problem.